A response, both fiscal and monetary, at a scale that's never been seen before.
I don't think they can maintain the illusion much longer.
Everything points to a deflationary environment.
This has to come home to roost someday.
COVID-19 has created immense change all over the world. No one has been left untouched by its impact. What will be the short-term and long-term effects for the households, corporates, and governments who drive our economies? What will follow? Will we see a swift recovery, or will we face a wave of global bankruptcies? Is deflation or inflation on the horizon, or both? And finally, what does the data tell us about what our future world might look like? In this series, we ask experts in business and finance from across the globe about our prospects in a rapidly evolving environment in which multiple waves of infection could continually threaten a road to recovery. Many household, corporate and government balance sheets were carrying excessive debt levels even before the virus hit. What started out as a deleveraging and liquidity crisis may now give way to a solvency crisis. But the response could be storing up imbalances for the future economy. The risks of both inflation and deflation have picked up. A wave of bankruptcies could sweep through households and businesses, while some governments may also face the risk of default. Social upheaval may accelerate. Growth may struggle to recover its former levels. The initial impact on financial markets led to a staggering response from central banks, particularly in the US, who were worried that the crisis of confidence could spiral out of control.
Powell came out and said rates are going to zero, down 75 basis points, and the Treasury market went from like 50 basis points on the 10-year all the way back to like 120, like in 2 days. So things were really ugly. I mean, we were close, and they injected, remember, $1 trillion, there's that T word again, $1 trillion of liquidity into the market that day. Like, why did we bail out hedge funds with $1 trillion? Oh, because the global financial system was on the verge again of melting because they were doing these variance trades with treasuries and the treasury market was imploding.
The support phase was all about keeping jobs and keeping businesses open and making sure that when the recession or when the recovery comes, businesses can very quickly return to the new normal.
So I think what you've seen across both developed and emerging markets is a response, both fiscal and monetary, at a scale that's never been seen before. So total fiscal stimulus so far, the IMF pegs at $9 trillion. In the US alone, it's around $2 trillion. When you look at what central banks have been doing, the Fed is now in unlimited QE. I think all of that speaks to the scale of the hit that we were facing.
For the moment, at least, I think the Fed is willing to buy everything. They want more QE right now because there is no buyer of last resort via share buybacks. They have to offset $250 billion a quarter in share buybacks, and it's hard to do that if the Treasury is not issuing enough debt.
Every day, the head of the Bank of Japan goes to work, cranks up the printing press early in the morning, starts printing as fast as he can so he can buy bonds and stocks. And I mean, buy stocks now. He used to have to buy ETFs and bonds. Now he can buy stocks. Every day, the guy gets there and buys as much as he can, as fast as he can. This is happening in a lot of places.
You look at the trillions of dollars that the Central Bank of the United States and all the central banks, the Bank of Japan, the European Central Bank, the Bank of England, have injected into the system. You'd be kind of crazy to get in front of that.
People are day trading with government money. So the government found a way to buy stocks. They just did it through, pajama traders. So that causes, I think, ultimately a bigger problem in that the solvency issues, the bankruptcies that are going to happen, the defaults that are going to happen. HIRST is a great example, right? It's a cautionary tale.
I don't disagree that central banks are, not only do they have a precedent and clearly an incentive to take this QE to whatever levels are necessary to pump risk assets, but I don't think they can maintain the illusion much longer because we just see this thing tearing apart at the seams.
The problem is you don't fix a solvency problem with liquidity.
If the outcome of the response is a widening of income equality, then social and political upheaval may not be far behind. We should not be surprised if there are some profound political and economic changes that get swept up along the way.
What we are seeing is that the pandemic has exposed inequalities, not just inequalities in economics and income and wealth, but disparities in access to healthcare, and even just, there are parts of the economy, parts of society that are more vulnerable to this.
The most likely thing is to increase income inequality. That's probably one of the saddest things about this disease, that both from a health perspective and a wealth perspective seems to be discriminating against those people who have the least in society. And so if you look at the types of jobs that have been lost, these tend to be disproportionately jobs that young people have who have less income, or customer-serving roles in the services industry, things such as working in hotels or working in bars, working in restaurants.
It's going to be more of a struggle because there will be fewer jobs, less overtime, a lot will have diminished savings, promotional prospects and so forth and so on, if the economy is in damaged state, are going to be worse. And I also think that this whole episode has given a massive shock to overall confidence.
There's a lot of anger about the little guy being let go and the big guy being rescued and bailed out.
How far will this crisis change the politics of our societies? Okay, this is a really big question. Are we going to go back more or less to business as usual after this is all over, as effectively happened after the global financial crisis, or will this be a bigger event politically? And I think at this stage, we really don't know. And again, if it is a bigger event politically, it's not clear where it goes.
I don't know what's going to happen in America after November. I do know that there are pension plans that are essentially underwater. I do know that there are states and cities which are essentially underwater, but they're also in other countries too. This has to come home to roost someday.
It all comes down to politics in this country, because you can write a big enough check in theory if you're the US government because of the reserve currency status. So, I mean, given the animus in the air, if you were to come in at this point and say, we're going to cut policemen and firemen's pensions, I mean, can you imagine?
But in Italy, they're very badly hit by this crisis. Euroscepticism has grown dramatically in what was once one of the most Europhile of countries. The establishment is really pretty discredited.
My sense is that Europe has actually pulled together better than I thought it might when this thing first seemed to be an Italian problem and then a Spanish problem. And the fact that it hasn't become a German health crisis to the same extent, and yet Angela Merkel, the chancellor, has been there working with Emmanuel Macron of France to try to create solidarity on a financial level. I think that's quite positive for Europe.
Overall, I think the relationship between the U.S. and China is going to continue to deteriorate, which means that we're going to likely have more financial warfare.
I think most ASEAN countries don't want to take a side, right? And I don't think they want to be pulled into. So I think they want to, remain, trade partners, investment partners of both the U.S. and China. But I can believe with the U.S., turning more inward, that they have to remain open to China.
It would be very easy for us to get quite xenophobic, very easy for leaders in governments to play the easy card of xenophobia and populism. And I think people in government need to be really mindful of not taking the easy option, but actually going for the building connections with the outside world, because that's where we're going to succeed in the longer term.
A very real concern is the tribal debate about deflation and inflation. Both may rear their ugly heads. It could just be a matter of time frame.
There's a view that there's going to be deflation out there because demand will have diminished. I happen to be of the view that because of the dislocation of lots of resources and logistics and channels, i.e. closure of capacity, there's quite likely to be inflation. And I think it's quite possible that in 6 months, a lot of prices of a lot of things will be higher. For example, I'll give you a small one. Dentists have reopened this week. 2 people have complained to me, they've all put their prices up. What a surprise.
This is where probably the biggest question in the world today is inflation. And for the life of me, I don't understand how the media hasn't picked up on this theme. You know, as someone invested in real estate in 10 years, QE absolutely has caused inflation in real estate.
It's clearly a risk that you get an onshoring and a disruption to supply chains and factories essentially moving closer to where the consumers are. So if you did that, that's not going to happen overnight. That's going to take maybe a year at least. But as that process plays out, if it were to play out, then clearly you would see upward pressure on prices. And so you'd expect inflation from that factor too.
I think because of the trade war and also the fact that this virus has shown that companies probably don't want to depend and be too reliant on any single one country. I think this theme about diversification of supply chains will continue.
A lot of analysts think that inflation is not a threat because of the deflationary conditions subsequent to the 2008 recession, but this current economic shock is very different. In 2008, the economy suffered no supply-side shocks. It was just a contraction in demand due to a collapse in credit markets. In 2020, there are widespread supply chain disruptions.
I think that there are going to be a lot of deflationary forces at work because on a fundamental level, there's less of a capacity to spend. But by the same token, I think that companies are going to struggle with cost inputs. We're not seeing supply delivery times come down. We're not seeing the cost inputs come down.
Everything points to a deflationary environment. I guess with a much bigger part of people staying outside of the labor market, that's deflationary in itself due to the wage growth component of prices. I also think that velocity of money is very clearly slowing at the moment. So I think everything points to a deflationary spiral over the next 6 to 12 months. And it's basically, to me, a global phenomenon, not just a Eurozone phenomenon.
My view is that the Fed is going to overshoot and they're going to print too much. And emboldened by the international dollar demand, like that represented in the Eurodollar system, I think the printing is really going to become excessive as they have both the precedent and the incentive to do so. And this is going to set up the US dollar to enter the early stages of hyperinflation by 2022.
The only way you get that type of hyperinflation is when there's excess capacity. And when you put money into the system, there's no wealth creation and no business productivity. And so all that money gets into the hands of citizens, and then they're chasing too few goods. That creates the hyperinflation.
The global economy will recover, but it may not return to former growth.
But if you actually look at what's happening today, I think even with the lockdown kind of being slowly released, you do realize that things are not going to get back to normal right away.
It might be a prolonged recession, very prolonged. And I don't think that most people are prepared for that. They're used to things bouncing back. That's what Fed policy has trained them to see. The stock market's bounce back. Where's the economy? But if the economy rebounds to a certain level and plateaus at a lower level, then we could be looking at a very long period of economic sclerosis in this country.
We place around 60% weight on a V-shaped recovery. And by that, we're defining GDP returning to its 2019 Q4 level by the middle of next year, the middle of 2021. And then we're placing 40% weight on something resembling an L, where demand slumps and remains extremely weak for a sustained period of time. So if there was a second wave, I don't think that policymakers really have, they may have the willingness, but they probably don't have the ability to deal with a second lockdown and all that entails, trying to play whack-a-mole with all sorts of various financial risks. And so that could be a fairly bleak scenario.
With governments having the ability to borrow at near zero or sometimes even negative interest rates, there's a strong argument out there that says that there's less urgency in this economic crisis compared to the one that was happening under the global financial crisis of 2008 and 2009.
When everybody's back indoors, people are more tired, the weather's worse, will it resurge again, the second wave, a really big second wave globally? That would make a mess of the world if that happened. And remember the Spanish flu, which is the pandemic most like this one, as far as I can see. There were 3 waves, and the second and third, I think, the second was the worst. I can't remember whether, but it was worse than the first. But I think at least we can get through the next few months pretty well economically if we can continue to control the disease.
There will be a new paradigm here, but I do feel that economic growth and aggregate demand will increase. Again, we don't know the time frame on that, but I am optimistic there.
When you talk about the idea of bifurcation, the corporate haves and the have-nots, my greatest concern is that the have-nots are going to be spectacular disasters.
We won't just go back to where we would have been, but we could expect a pretty strong recovery in the end of this year.
People are back out. Again, as long as there's no great resurgence or there's a way to contain it or tolerate it in some way, I think you probably will see something like 80 to 90% back to normal in the next few months.
At the moment, we are massively, massively overestimating the effect that this crisis is having on our behavior. In the middle of all crises, we think everything's going to be different afterwards, and normally it snaps back to pretty much the same as before. So I'm really encouraging people to make sure that they really and intentionally build the learnings from this period into the post-crisis world.
A liquidity crisis was avoided by the prompt actions of global central banks. A solvency crisis may still be on the horizon. Flooding the global economy with liquidity may do little more than stabilize growth, but it may also increase the risk of inflationary bottlenecks if supply chains take a long time to recover. Meanwhile, a wave of bankruptcies could undermine growth and increase inequality. There will be a recovery, but economic vulnerabilities that existed before the crisis will act as a drag on its long-term trajectory. Our final episode asks if the economic and social fallout will lead to any long-term behavioral changes in the way that we work, live, and interact.